Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. As is usual at this time of year, I stop looking at my daily and weekly charts and instead concentrate on the longer term view using my monthly, even yearly charts. If you'd like to discuss any of these, I'd only be too happy to hear from you. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, let me now introduce today's longer term chart.
Today I'll be looking long term at UK feed wheat. I'm sorry this is actually quite a long commentary because there's a lot going on. But this continues to be one of my favourite, if not the favourite, long term chart. Why, you may say? Well, I have no other chart that has a 1975 to date uptrend, and that's currently at 66.10. An uptrend that is still valid. I just love that. I could also lather this long-term chart in long-term patterns, but I won't because it will obscure what is really going on. So the steep rise in this market peaks out in May 2022 with a combined key reversal down, bearish engulfing pattern and bearish opening long black Mariposa. Those 3 months of 2022, February, March, May, are really interesting as they broke up through the top of what I suspected might have been the big core pattern here, which this year I've downgraded, and that's the 2007 to 2022 ascending expanding wedge pattern. The break higher caused irreparable damage to this pattern. Since the May 22 high, prices fell in a juddering fashion, interestingly peaking once more in October 2022. It is this juddering fall that I wish to discuss now. You see, if you look over at Chicago wheat, we have there a very thin, tall, narrow head and shoulders top formed over 2021 to 2022. None such real pattern exists here. Or at least I drew an optimized neckline that disappears to the top of my monthly chart, but it really is way too steep. And as I said last year, and I quote, I suspect any that really use it may be chasing shadows here, but it's still there to look at, end of quote. Thus, 2 years ago, I still decided to lay out some potential targets below for this pattern. And we saw both the primary and hard to reach secondary target for this odd head and shoulders top reached, with the secondary target at 143 even reached in the drop for the pipe bottom made in June last year. Now 3 years ago I also laid out some further targets on the downside, and this related to the misaligned or even derived island top formed from the huge changeover gap back in early 22 and the much smaller 242.60 to 244.25 gap made at the end of 2022. The earlier gap we can all see has been filled. The small gap is even now, the one more recently is still open. Now the two gaps do not align, but even so, looking at the action from March 22 and to November 22 as a possible derivation of an island top, I said the following 3 years ago, and I quote, I am stretching the point, which I am, but that is also because I want you to see all the options and opportunities out there. This is not a classic island. But it is. But if it were, then a primary potential target X2 on the downside would be in the 171.90 zone, and the secondary very much harder to reach target X3 would be down in the 127.5 zone. End of quote. Well, target X2 at 171.90 was reached, and we even looked like in June we might reach target X3, but alas, not so, or at least not yet. This brings me to my next point, or points, is a review of the actions since May 23 to date, and also from August 2020 to date. The near action from May 23 to today looks very much like a bearish cat's ears pattern, completed but somehow still not triggered. For guidance, a cat's ears pattern is typically seen after a large fall, such as the one we had in late 2022 and early 2023. A large fall, we then have effectively a small double top, but not where you would usually find such a pattern at the top of the market, but at the base of a fall. The neckline for such a pattern is highlighted in purple on my monthly chart and is currently 168.70. Up until 2025 we hadn't properly broken down through this neckline. However, in 2025 we had a dramatic move down through the purple neckline, even if it was attributed to changeover, with a bearish closing long black Mariposa in June that reverted back up again in July, with a combination of a key reversal up, a bullish engulfing pattern, and a bullish opening long white Mariposa, together making a pipe bottom. This threw a major spanner in the works for such long-term patterns. The reactionary immediate countering monthly key reversal up for July went back above the purple neckline but stopped at the 50% absolute Fibonacci line at 180.5 and just under the newly drawn bright green 2023 to date upper bear channel line, which is currently 176 even. The question this posed back then, and is a longer term question, was whether this was a reactionary single month move higher or the beginning of something else. I have repeatedly said in my weekly London UK Feed Week video commentaries that I believe, and still do believe, that this was a single month move aberration higher, as the levels subsequent to the action look similar and did not and do not look like they are forming a strong enough base. Not yet. Now, I am prepared even now to start looking at the possibility of a new base of support, but it doesn't look likely right now. There's one caveat to this basing higher idea, and it's the bright green mid-23 to date big bear channel. It's currently 128.30 to 176 even. Even with such a big reactionary move up, we are still now sitting within this big bear channel, hence a bearish incentive to me. It appears that as such, and it does have the advantage of already having had at least a minimum 5 touches necessary to legitimize it as a bear channel. With this in mind, I last year set out some targets below for the two patterns I have so far discussed. The bearish cat's ears pattern and the larger complex head and shoulders pattern. Now thus we have a primary target X3 for the bearish cat's ears pattern down in the 127.5 zone, below the bright red and big old 2005 to date uptrend, which is currently at 133 even. And a secondary harder to reach target X4 down in the 112.85 zone. For the head and shoulders top, we would have an even lower primary target X5 down in the 164.20 zone, close to where sits that oldest uptrend I have on any of my 200 or so charts, and that's the previously mentioned 1975 today, yes, half a century old, just over, 1975 to date uptrend currently at 66.10. I'm not even going to give you my secondary harder to reach target for this pattern. It's below 0. Please bear in mind that these are very long-term targets, stretching possibly over many years, but they are still targets below for these patterns that are above. It'll be interesting to see how 2026 treats these patterns and their targets. I guess it comes down to literally 5 things. The bright green bear channel, the purple neckline, currently at 168.70, the bright red 2005 to date uptrend, which is currently 133 even, and the 2 key Fibonacci levels, the 38.2% Fibonacci line and the 50% absolute Fibonacci line, and they're at 138.05 and 180.65 respectively.
Thank you for watching and listening. This annual broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.